This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is a show where 50-plussers and anybody else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes or Apple Podcast, type in Old Dogs, spelled D-A-W-G-S, find our podcast and subscribe. Well, we have a fun show for you today. We have a returning guest, and I am so stoked to have him on because it has been a long time. I think last time he was on was January 2018, so almost 2017. So it's been a while, and he was on an episode number 175. Now we're over 500 episodes here, but he talked all about multifamily, and he has a great story to tell. His name is Mark Kenney. Those that have been listening to the show for a while will know that name. Anybody in multifamily would know that name, especially in the Texas area and some of the areas where he's also really involved. Mark is a seasoned real estate investor, coach, two-time best-selling author. Now, last time he was on, he was only a one-time best-selling author, and founder of Think Multifamily. Mark started his apartment investing career over 20 years ago as a side hustle while working 80-plus hour work weeks in the corporate world. He has since purchased over 8,000 units in just the past few years in 6 different states. Mark has a passion to help others achieve success quickly in multifamily investing. He specializes in educating others how to go big, fast through syndication. In his first year of coaching, he helped others acquire 6,000 plus apartment units worth over $380 million. The smallest deal any of his students purchased is 90 units. So it is possible to go big, fast even, if you don't have the experience. His coaching style is no fluff, and he is passionate about results and providing unmatched service. Mark is a graduate of Michigan State University in accounting and is a CPA. He has also provided IT consulting for 20 years and is leveraging his vast IT experience to bring new creative technologies that will help others in the multifamily space. He has worked for organizations such as KPMG Consulting, EDS, SAP, HP, and founding his company, Simplifying IT, which provides IT services to Fortune 500 companies. Wow, Mark, you have really done a lot since the last time we talked.
Yes, it's been pretty active, Bill, and appreciate you having me on today.
Oh, it's my pleasure. It's great. I always see your name popping up all over the place and these great deals all around. I said, gee, I just got to get him back on and get up to date here. So, maybe you can just kind of, give us a little bit of your background, although we had that in the first show, but still, how you got into multifamily and what you're doing today.
Yeah, no, for sure. So you had mentioned CPA, did IT consulting. I started buying small multifamily when I was a senior in college, so over 25 years ago, and continued to buy, but it's small properties. And it was like, well, I could save up money for a couple, in 2 years, I could buy another property, another 2, 3 years, buy another property. And it was, it'd take me 100 years to get to where I needed to be, if you want to say, to be financially free. So I had the IT business, as you mentioned, and it was, going pretty well, if you want to say, from a financial standpoint. But hours, my wife says 80 hours. I say I used to work is actually not true. It's much more than that, but used to probably 90 plus hours a week. So it caused some issues, family wise, because I just wasn't available. So in 2013, my wife Tamil and I said, she's like, this is not working, right? You're just never here. So I said, well, why don't we look at doing larger multifamily properties? We both love real estate, started buying at a young age. And we started looking at doing syndications back in 2013, raising money from other people as well to buy larger properties. And, we continued we're in 9 states now. And that's kind of where we pivoted a little bit. We were strictly in Texas originally, mostly just Dallas, actually. And then I have a twin brother in the Atlanta area. We started going there back in 2015 and started buying a lot there, and just started looking at different areas because some of these markets have gotten really, really expensive, at least in my mind. And, we can get better returns in some of the other markets. That's why we've kind of expanded out. But we've really leveraged our, if you want to say, reputation with brokers and things like that we've done business with in certain markets to kind of help us get into other markets as well.
Wow, that's amazing. Yeah, I just corrected your. I said 6 different states. You're in 9 different states now. That's awesome. Wow. Yeah, the especially in the Dallas Fort Worth area, talking about, man, the prices going up over there. It's just, there's so many people moving there. It's just amazing.
Yes.
It is just between Texas, Florida, and Tennessee. I mean, I think half of those people, probably more than half of those people, are coming from California, my state here, because
Right.
we're bailing in a big way, and I'm getting ready to do that in 2022. So,
Oh, okay.
yeah, haven't figured out where I'm going yet, but my wife and I are doing like little road trips here and there to check out different areas. So,
Great.
yeah, it's the demand for multifamily is huge, and you kind of touched on it. You're not only a very active investor, but you also have an educational program too. Can you talk a little bit about that?
We do. So, really, if you would have asked me 5, 6 years ago whether we would do an education, I would have said no. I had really no aspirations of doing it. What happened was, just through some circumstances, we're like, man, I wish people were teaching, more information, right? And that the people that were educating would provide more assistance, if you want to say, one-on-one coaching and things like that. So we started initially doing kind of webinars and events, and then both my wife Tamil and I just fell in love with the whole educational piece. And we felt we had, we've done, I guess, probably over 60 transactions. So we felt we had some experiences that could be shared, good, bad, and in everything, right? We'd share everything, not just the great things that happen, but also for those people that maybe are in a similar situation with me that I was, where they want to, maybe they're already making decent money. Some people are, some people aren't, but they want to get to where they can live life on their own terms and decide, when they work, when they don't work. So we started thinking multifamily. We have a group called the Family Syndication Group, which is really structured around a family culture, people helping each other, where you can come in and there's no reason to start with, unless you want to, no reason to start with, small properties. You can start 100 plus units. I mean, in fact, last week closed on a deal with someone in our group. His very first deal was about a $25 million deal, very large
Wow.
deal. Not necessarily the norm, but that's his first deal he ever did, right, in the multifamily space. So it can be done, but the whole idea in our group is that you probably have a skill set that you either already have or can easily be developed, and don't worry about knowing every aspect of multifamily and syndication. Just team up with other people that can maybe work in, maybe they're stronger in an area than you are, and you're stronger than them in an area, and you work on things that you're good at and like to do, and hopefully not have to work on things that you really don't like to do that much. And together as a family, if you want to say we can do deals together and get deals done quicker, easier, larger deals, and less painful, frankly.
Right. Well, when you mentioned the family aspect of it too, I mean, it literally is a family affair for you. I remember seeing, some of these videos early on when you were doing some of your conferences. I mean, you've got your kids there, you and your wife are up there. No, it's great. It's great. I mean, you guys are totally a multifamily syndication family.
We are. We even do vacation together. So last year, unfortunately, we didn't, but this year we are doing one in June. So people can bring their kids if they have them, family, and it's just a way to hang out. And it's something I missed when I was doing IT. I really didn't have any of those aspects, and some people might not really care that much. I felt like I didn't care about having those, kind of personal relationships. I just was doing work, and I was there to fix problems. And, your people I worked with, I didn't really pay as much attention to because I was just there to fix problems. And with multifamily real estate, it's completely different. You have to have those relationships. And now, all our friends are from the group, and we have people here from our group just recently. People over on Sunday. We went out to dinner on Sunday or Monday or Friday with a few people from our group. We've done catamaran, with people from our group, and we do the summer vacation as well, just to kind of build those family relationships.
God, that's fun. That sounds like a blast. Well, I think the first thing that comes to mind is you say go big, go go fast, and
Right.
so somebody with absolutely no experience and they come into this and they're going, oh gee, I mean, I'm gonna come in and buy a 100-unit apartment building. I mean, they're gonna look at me and say, who are you? And I don't have any experience. I don't, and I've never raised funds. I mean, it just seems so ominous for a newbie. How do you change that mode so that folks coming in there can really see that kind of success?
Right. And I think you're correct as far as, we sell properties too. And I don't, I'll tell the broker, I don't want anybody that's a new buyer, we're not going to sell to someone as a new buyer. People say, well, why? It's like, well, there's so many things, there are 100 things that can go wrong on a deal, right? So for us, in capital, you mentioned about bringing capital, underwriting deals, maybe, having a balance sheet and for loans. Those are all things that, very few, if any, people have come into our group and they're like, hey, I got it all, I got all these aspects figured out, right? Reality is typically someone's struggling somewhere and they're missing a component. And the whole thing is, hey, you come into the group or you find partners, right? You don't have to be in a group, but you find partners and they make it easier because you're working typically in one area initially, an area you like, probably an area you're good at. And then as time goes on, you start expanding into other areas. And people say, well, how can I do it? Well, fortunately, we have many, many success stories of people, and they're not rocket scientists or anything like that, right? They put the work in, but they've also built those relationships and they figure it out where they can add value to somebody else. And the average person will say, I have nothing of value to add, right? I'm brand new, kind of to your point. Well, you probably do. I mean, it could be that, hey, you like numbers, or it could be that you have some capital for earnest money or to sign a loan, or you're a hustler to go look at deals, or maybe you're more flexible and you can get on an airplane and go look at deals for somebody else that is busier because maybe they have a family. So just trying to plug people in those areas and understanding that they don't have to do it all on their own. And if we had, one or two examples, it would be like, well, yeah, the one or two examples. But when we have, we closed 7 deals this first quarter already. So we have many, many examples of just regular people, if you want to say, that have been able to do it successfully. It's not a mystery how you do it, but it also does require work. It requires action. And the biggest thing is when you're looking at, podcasts and reading books and listening to training, I don't care whose it is, ours or anyone else's, you're just scratching the surface. You have to insert yourself. And, we give opportunities for people. Hey, we're doing due diligence on a property. And even if you're not going to partner on the deal, you can go and, visit a property and go through due diligence and learn those aspects. You have to get that real life experience as fast as you can because you're going to learn so much faster that way than just, books and things like that.
And you mentioned it was really interesting too. You refer to we closed this number of deals in the first quarter. Are you referring to your students when you say we?
Both. Yeah. So I'm still very active, doing deals. I do less deals, but there are certain deals that I'll have that I'm kind of, if you want to say, leading directly, and other people in the group can come in and kind of help in aspects. We have some, so I'll coach no matter what. If someone's in the group, it's all one-on-one coaching, kind of direct access to me. We have some deals that closed, last year, for example, where I wasn't involved in from a partnership standpoint at all. And then we have deals that have closed where someone in the group, they're kind of doing the hustling, right? They're contacting brokers. Typically, it's brokers that we already have relationships with, so which gives them the credibility. And they're kind of doing the hustling of going and look at deals, finding deals, analyzing. Maybe they're analyzing 100 deals before they, a deal makes sense, as an example. So yeah, when I say we, it's the group together as a whole.
That's awesome. Now, the people that you're working with, do you help them to find partners, help them to find funding? It sounds like you mentioned, you have brokers that you already have contact with. Is that part of what you're doing as you're coaching?
It is. So there's really nothing that we won't share. Meaning, some people are like, oh, how you're going to give broker contacts? Why would you do that? We share broker contacts. We have a built-in team, right? So with attorneys and CPAs and mortgage brokers and insurance brokers, that all kind of comes together, and it makes it easier for the average person, because it can take years to build a team like that. But that's the broker contacts in particular is critical. If you call someone, you have no experience at all, never done a deal, and you're looking at a 100+ unit deal, you're probably going to get very little attention from a broker, because they don't make any money unless they close a deal. So they're going to go to their go-to people when they're trying to sell a deal.
Yeah. Well, that is a big one. I mean, a lot of folks that I know starting out, that's one of their biggest challenges, is building those broker relationships without having a track record. Can be challenging. So, one thing you mentioned earlier too, that I think is really interesting. You said as you had no interest in getting involved in coaching, but you saw certain things lacking out there. What are some of the things? And again, I'm not looking for any dirty laundry here, but
sure.
But basically, what did you see that wasn't being provided by some of the programs out there, the coaching and so forth, that people are involved in?
Right. So two main aspects. One would be the culture, which frankly, when we started Think Multifamily, that was low on my list. It really was, but it was number one on my wife Tamil's list, was building a culture. She would say, oh, we'll build this group and we'll go on vacation together. I'm like, who's going to go on vacation together? I'm like, what? I'm like, I'm a IT guy and a CPA, right? Background wise, I'm just a transaction guy, right?
Right.
So number one, culture, we just didn't see it. We saw other groups in our mind and involved in groups too, where it was very competitive. People would compete against each other. Rarely would they work with each other. They didn't share information. And then you have some of the just pure technical aspects of it, where I'm like, man, there were so many things that I thought we didn't get taught that we should have been taught before our first deal, just technically taught, and then sharing some of the bad things that have happened, or horror stories and things like that we didn't see really happening that much. And then we didn't really see where the responsiveness. I give you a list of every single person in our group, and I can guarantee without a doubt they'll all say that I'm super responsive, and I don't know how he does it. He's very responsive, and I'm never waiting on him, which is true. And then the one-on-one aspect, we didn't really see most of the groups. They all had kind of sub coaches and things like that, where I always, as a coach, always wanted to be involved in that aspect of it. I think you stay sharper that way. I like that aspect of it. And then the kind of third kind of piece really would be, a lot of the groups had, in my opinion, what I call some silly rules. Now, whether people think they're silly or not, but they have rules in place, and they're really typically self-serving rules. They're not really to better the group, in my opinion. And we don't have, in my mind, those silly rules that a lot of the groups have, like, hey, you can't partner with people outside the group. And it's like, why is it any of my business who you partner with? I mean, I'll coach you, right? But you can partner with whoever you want. You can have people come in and sign a loan, whoever you want. If I'm not part of the deal, if I'm not, I have no business in my mind telling you how to run your business. I'll coach you and I'll help you and share experiences and things like that. But just groups like that, or they charge extra fees to close a deal, like they're a broker, so, hey, not only you have to pay me for coaching, you have to pay me to close a deal. You're not talking small dollar amounts, and it just, in my opinion, it's not right. So we built the whole group around the family, the culture, all technical aspects, sharing the good, the bad, and not having in our mind these kind of silly rules, and having direct access to me pretty much whenever you want.
Wow, that's awesome. Now, there's some, I'm sure you've encountered all kinds of newbies coming aboard here. There are those that come out and just like gangbusters, they've got their first deal.
Yes.
And then you've got others that are struggling, and it may not be, because of what they were taught, but they're obviously something that holds them back. What would you say, on both ends? What makes those newbies that just boom, that just capture that first deal, run? And then on the other side, what are the other people lacking that prevents them from doing that?
Yeah, and I will say in some cases it can be a little bit of luck. You're in the right place, the right time. So we've had people get a deal within a month. Not common. So anyone that says, hey, get 100 plus unit deals in a month, that's not common at all. 6 months is probably more common to get into kind of a general partnership aspect of it. Some of the things I think people that they do to help them with that, I mean, they get educated. That's number one, but it's just education, right? They kind of get involved in a deal that's active. So they'll be like, hey, I'll help you wherever you want in a deal. I'll come to due diligence. I'll do those things, right? That's how you're going to learn. They don't make excuses, right? I mean, all of us can make excuses and we probably all do some respects for different parts of our life, right? But, at the end of the day, everyone has it's a level playing field, right? They have access to me, they have access to the team, they have access to everybody in the group. But so if we give all the names and contact information to everybody in our group so they can reach out to people. Some people reach out to people, 20 people in a week, which is a lot, obviously. Some other people rarely, if ever, reach out to people. Well, that's their own decision whether they want to do that or not. I think being consistent is probably a big one too. If you say, well, hey, I can spend, it's like working out. If you say, well, I'm going to work out 20 hours, once a month versus working out an hour a day or whatever, you know what I mean? It's like you have to be consistent because you actually learn more that way and you get better results. A lot of people don't want to sacrifice, right? I mean, you're probably going to have to give something up. If, maybe you're like, well, this is important to me, but maybe it's not important enough. And it's fine. Like, I tell people you have to make your own decision, whether it's, I'm into fitness a lot and I eat, really clean and things like that. But people are like, well, I don't want to eat that way. Well, that's fine. And then you don't have to, right? But if you want to get better results, typically you're going to have to eat better, exercise more. And just like with multifamily, if you want to get better results, you're probably going to have to sacrifice something. Maybe it's time, maybe whatever it might be. Some people too aren't realistic. They're like, hey, I want to do, 5,000 units my first year. And I'm not saying that's not humanly possible, but it's not realistic. No difference in saying you're going to lose 30 pounds in a week, right? It's not realistic for the average person. And typically you start and you just give up. But I think, pivoting, grit is probably one of the main ones. Like, okay, well, why is that so important? Because you're going to get knocked down. You're going to get discouraged. I don't care who you are. And having the ability to kind of keep at it where other people are like, man, this is just too hard. That's probably the biggest differentiator. But I think the people that have not done as much and maybe not as fast is they don't do any of those things, right? Or they do very few of those things. And there are exceptions to that. There really are. But it's connecting with people in the industry, connecting people in the group. If you don't do those things kind of fundamentally, you're going to struggle. And then, having an action plan and following that and pivoting if you need to. And it's no different than someone who comes in and says, I'm only going to buy in Dallas, Texas. That's fine. But you need to realize it's going to take you a lot longer. The returns are typically going to be lower, and it's going to be a lot harder to do that versus expanding out and saying, well, I'm willing to look at other areas outside of these hot markets. And, if you are, the more you expand, the more opportunities you have, the more relationships that you build. And going to events, some people are like, well, I'm busy. Well, we're all busy, right? I mean, do I want to go spend 2-3 days at an event? Fortunately, my wife Tamia goes with me, but kids sometimes don't go and things like that. I'd probably rather be home, but I'm willing to make those sacrifices to go do that. And a lot of people just simply aren't willing to do that.
Well, are there certain, we talk about criteria for properties we look at, but what about criteria for somebody that is coming into they just want to get that first apartment building? I mean, there's got to be certain requirements where maybe a certain amount of cash they must have, a certain kind of income. I mean, if somebody is a minimum wage worker that comes in and they've only got, a couple $100 in the bank,
right?
They're not going to probably have a lot of, I don't know, it seems like it'd be more difficult.
I'd say, yeah, partly true for sure. I mean, we have coaching programs, so I mean, there is a cost to that. But let's assume somebody's in the coaching program and they have $0 to their name. There are people that have come in like that, and what do they focus on? They focus on the things that don't require money, so they can find deals. You don't have to have any money to find deals. You don't have to have any money to get really good at underwriting deals. You don't have to have any money to get really good at asset managing a deal. But that's half of it, right? The other half, you kind of do need to have money, right? Or you can get money. So if you want to put earnest money down on a deal, we have some people that put earnest money down on a deal and get part of a general partnership and then do that for somebody else that doesn't have the money. So true, you need to have money, but you don't necessarily have to have it yourself. The deal needs to have it. We have people that don't have a very good balance sheet or liquidity. Well, I mean, whether it's me or somebody else in the group can sign on a loan as a general statement, and you don't have to be able to do that yourself. Somebody else can do that for you. So, and then the last piece really is around equity. If you don't have the equity yourself, but you can bring equity from other people, you don't have to have money to do that. So I would agree 100% that there are more opportunities without a doubt to get into a general partnership faster if you have, money yourself. But we have many, many examples of people that don't. And half of the, if you want to say the areas of a syndication, you don't have to have a penny in your name to get really good at it and provide value to other people.
So if you have someone, let's say, that is just really good at finding deals, maybe they got this great off-market deal and it's in a perfect market, are you teaching your students how to take that to somebody and present it in such a way to get the financier or the person that's going to be able to help fund that?
Yeah, the financing piece, they're out of luck. I mean, they have to have somebody that's going to partner with them for sure. They can present wherever they want to a lender, but typically on the, if you want to get a decent loan, you're going to have somebody be a key principal with you on that. And there are, people for sure that do that on a regular basis. Presenting to investors, absolutely. The biggest thing there is it's okay to tell your investors. Let's say, I was an IT guy and trying to move to multifamily. People are like, well, Mark's an IT guy. Well, they don't necessarily have, let's say they don't have credibility in the multifamily space. Teaming up with somebody that does, and in being totally transparent with, the investors, and yeah, I'm new to this. I'm one person on the team, but I'm partnered up with Bill, and Bill has a lot of experience around, multifamily, and he's done it for, X number of years and has X number of units and things like that. So leveraging the reputation and track record of somebody else. And, to a lesser extent, you can also invest passively in a deal. And if you can say, I'm a partner in X number of doors, which is true, you're a partner in that. I don't play the games where a lot of syndicators do that say, oh, come and invest with me. on this deal as a passive investor, you're going to learn so much. You're going to learn how to syndicate deals. That's not true. So people say that it's not true. You're going to learn a lot more than you would if you didn't invest. But I would say in that example, the more critical piece is that you're building a track record to say you're a partner now in X number of doors, and that's more valuable. And you will learn some, but you're not going to be able to be a passive investor and go out and syndicating a deal. It's just not. It's not practical.
Right. Do you have a lot of sort of networking amongst the students in the program where, you may have some folks that are, that do have the cash, and then you have another person with this ability and so forth that they come together, or there's opportunities for them to network and come together on deals?
We do, yeah. So we have like a closed Facebook group where a lot of stuff happens there, and then we have scheduled calls as a group. Every scheduled call, we start out by going through introductions, everyone's new, and then also deals that are in the works and where that person needs help. There's no reason to talk about things you don't need help on. So it's all geared towards around, I have a deal and here's where I need help. We've never not raised capital for a deal, never not closed a deal like that. So, and then we have the events that are open to the public, and then we have closed events as well, which is really good for people in the group to kind of meet each other in a smaller environment, build those relationships and things like that. So yeah, there's no shortage of the ability to network inside the group. And then I kind of mentioned earlier too, you also get a, list of every single person in our group you can reach out to as well. And then we have a list of people in the group and kind of where their skill set is. So if they have a balance sheet or liquidity and things like that, you can go look at that as well.
Right. Now, how did COVID hit you as both an investor and multifamily?
So I think multifamily, very little impact, meaning, we still have a lot of people that are joining the group, getting deals and things like that. So that by itself is pretty minimal impact. Getting deals, we had a couple months there, but just a couple months where it was very, very slow. I think most of the brokers were trying to figure things out. Nobody really knew what was going to happen. That was pretty short-lived. We ended up closing, a lot of deals last year and so far this year as well. And we have other deals under contract. As far as deals we own, the biggest thing we have a lot of deals to compare. Over 50 deals we can look at across different markets and say, well, why are some deals performing better than others? Occupancy is something that people look at, somewhat meaningless in my mind, because people can live in a building and not pay. So you really need to look at the bad debt of what's going on in the properties. So if I look at our entire portfolio, the properties that have had the hardest time, it's market driven. So it's, for example, maybe it's in a higher crime area, just is, right? And it's a less favorable sub-market that's going to struggle a little bit more on the bad debt side and potentially occupancy as well. And then some of the properties we own, they're not, even though the state might be landlord friendly or so-called landlord friendly, some counties aren't. So I'll just say it. We own a couple properties in Savannah, Georgia. I'll probably never buy in Savannah, Georgia again, frankly, because
really?
At least where we're at, those properties, they were tenant friendly before COVID and are more so now. So tenants are like, why are you calling me? We don't have to pay you. And then we have other areas where we've bought where, people are evicting, during COVID, the judges are. So we've learned a lot through that. Fortunately, as a whole, multifamily, including our portfolio, has done, very well considering the circumstances. So it's really been a positive, and there's more money coming to multifamily now, as far as we can see, for investing. But it's those high crime areas. Look at it the way a lender looks at a deal right now. If you have, one lending option, there's probably a problem with the property. If you have lenders that are kind of, trying to fight to get your business on a property, that's going to be an easier property typically to operate, typically to get investors in. But yeah, we've pivoted a little bit. I mentioned, market wise, and that's the only market right now, top of my head, that we're in, that I'd be like, yeah, I'm probably never buying there again. And I'm sure the people there, they have done really well during that. Ours have not. done as well, because people just don't want to pay the rent there, and they're not required to. So still occupy the building, which is worse. Now, so you have somebody living there causing damage on a property and, using different utilities and things like that, and you can't get them out. So that's a problem.
Right. And are you seeing property values going up, stabilizing, declining? Where do you see, for the most part, in the multifamily area?
What we're seeing right now in a lot of markets right now, cap rates have compressed, which blows my mind, and continue to compress. There's a lot more money coming to multifamily. I would say even the last 60 days in markets we're in, several of those markets we've seen compression like I've never seen before. And in one market in particular, I've never seen it that fast before. So, where it will go, I don't know. People have been saying, multifamily is overvalued since 2013. I'm surprised that cap rates continue to get compressed, but a lot of people also are getting better debt. I say better, different debt terms. A lot of people are using bridge, which we do a lot of bridge loans anyways. I have like probably 22 bridge loans.
Wow.
But it doesn't mean that Fannie and Freddie aren't still good options. But a lot of people that were only Fannie and Freddie before are looking at some of the other debt options, and it's very, very strong right now for multifamily. So they're able to make deals work easier because of the higher leverage, for example.
Now, they did have some COVID restrictions, Fannie and Freddie, right? Are those still in effect?
So they have some restrictions. I mean, they're pickier, if you want to say, for sure, where they're lending deals and things like that, because they can be. They have, called kind of the COVID reserves, where depending on where it started versus where it is now, it's better now. But it's where, let's just say as an example, the lender says when you close a deal, you have to put in, a whole 12 months of mortgage payments. So give me, Mr. Buyer, give me the money to the lender. The lender will hold on to that for you. And thus some of that's changed, or it's gone down a few times for the better. And then the duration of how long they're going to hold it. They might hold it for a year, up to 3 years potentially. And people are like, well, hey, I'm going to count on getting that back. Well, you know what? This is all new to everybody. Bridge loans have had interest reserves for a long time, but this COVID reserves for Fannie and Freddie is newer, and where it's going to all shake out, and whether the lenders are going to be like, well, here's your money back, or they're going to go, well, you know what, this one little clause in the loan agreement, so I'm going to hold your money longer. I don't know. We'll have to kind of wait and see how that shakes out, because it's only coming up now on a lot of these deals, and we'll see how willing the lenders are to give those proceeds back or not. In some cases, they don't have a choice. After a certain period of time, they have to give it back. But yeah, the COVID reserves are still there. They're lower than they were before, and the time duration of how long the lender holds it is lower than it was before as well, which means that they have more confidence in the market.
Right. Well, when we talked, I know that there was kind of just a different approach. Most people that I know, have been doing value add investing, but it was a real short timetable. It was sometimes a 2 to 3 year hold, and then they sell. Are you seeing a shift in that? And do you buy for the shorter term or a longer term in your multifamily investments?
Well, we're going to it where we're going to typically have a 5 to 6 year hold. And that's what we would tell investors, that, it could be less than that. It could be longer than that, depending on what the market's doing. We have a deal selling now. We sold one a few months ago as well. We'll probably have about 4 more deals we're selling this year. And it's really a function of the market has gotten, in some markets, in my mind, ridiculous from a price standpoint. It just makes sense to do it. My philosophy, if you want to say, is that, if you tell investors it's going to be 5 or 6 year hold, and you're, let's say you're cash flowing where it might be, but you haven't done like a, bigger payday like through a refinance or a supplemental loan, you probably owe it to the investors to sell the property. But we have some properties that we'll hold on to probably for quite a while, because we have one right now where, it was a very low occupancy. It's a very large property, 568 doors. We're putting $21,000 a door rehab into it, which is a lot. So we have a similar one to that where we're doing a second refi after just a couple of years on that. We put $14,000 a door rehab into that. And, you know, I don't say it's new, but almost everything on it's new. So those might be ones you hold longer, especially if you can do, refinancing, supplemental loans, pull all the money out, and investors are in it with $0. It's pretty good.
Yeah, that's great. Well, there's also a lot of folks that in this space that are talking a coming recession here, and maybe as soon as the fourth quarter of this year. I know it's not. It's always a dumb thing to ask people, what their feeling is, because none of us can predict the future here. But are you sort of preparing as you work with your properties, as you acquire new properties, for a shift in the economy?
Well, yeah, I mean, those same people, let's listen to their projections and podcasts from before and everything like that. 99% of the time, they're wrong. They've been saying it, right? I mean, all the stuff during COVID, people were like projecting was going to happen. Even some of the big firms, cap rates are going to do this and that. It's like, everyone, nobody knows what they're talking about. Frankly, it's all a guess. So if anyone acts like they really know, they don't. What I would say is one of the biggest lessons learned, hopefully for people that are investing in really anything, is that no one could have seen this coming with the COVID and everything like that. And how or if are you adjusting it all? And one of the biggest things, when people say, some of the even guys out there, gurus like, cash is junk and stuff like that. That's one of the most ridiculous things I've ever heard. You do need to have cash set aside. I mean, you don't have to be ridiculous about it, but you need to have cash set aside on these properties where, frankly, earlier on properties we bought, we didn't have enough, we didn't have enough extra cash. You want to say they're fine. We've never not made a bill or anything like that. We've never done forbearance or anything like that. Hopefully never have to. But I can tell you, if nothing else, whether recession or not, pandemic or not, having extra cash there in your operating account, where you want to put it, in reserves is a good thing. And having these reserves as well with a lender, in my mind, is actually a good thing. And an investor should hopefully feel more comfortable if we have 12 months of mortgage payments sitting there for a whole year with a lender, plus you have capital, reserves, and you have, replacement reserves, and you have, working capital, those things together, you might have a couple of years of payments sitting there. So my mind, newer deals we've, done, and we've gotten better with this over time as well, raising extra capital to have that extra, what if, is probably one of the biggest things people should be doing, and not skimping on that.
Right. I think that's smart. That's definitely smart. In any season, I think that's smart.
Right.
That's great. You mentioned a little while back too about hot markets. Now, do you have your hot markets, areas that you really think are especially good at this time?
Overall, so we've bought a lot in Georgia, Atlanta area and things like that, and it's getting much more difficult to buy there. We're selling some properties there instead. I do think Southeast as a whole. So I still like Florida a lot. We did 3 deals in Arkansas last year, and I consider probably not a sexy market, but man, they were evicting during COVID and continue to evict, and there are a lot of reasons, and then the bad debt and things like that were very, very impressive there in that market. So.
Northwest.
Yes.
Yeah.
Exactly.
Okay.
Exactly. So that's interesting. We own in Kansas and continue to look there, but I would just say, whether you understand this or not, you need to at least understand the difference between cash accounting and accrual accounting, and not to get so much around it. But the reason I say that is because all these people that are in markets, and some of the markets we're in that are really, really hot right now and selling for a lot of money, the bad debt's pretty high there as a norm, which is surprising. But we need to understand when people say I'm, 95% occupied and here are my collections, if you're buying a deal, you need to understand what are they actually collecting. And accrual-based accounting will not tell you what they're actually collecting. You need to know what they're collecting from a cash basis. So again, not to get into all the details on that, but just put that in the back of your mind that you need to understand what they're collecting from a cash basis, because a lot of that bad debt will not be written off because it won't be written off typically for people until they evict them. So you have some of these properties that have, several $100,000 of bad debt, but you look at their trailing 12 and you look at it, you wouldn't catch it. So be careful, really, really careful on that.
So what kind of documentation would you request to do that? I mean, talking the, bank statements and where are you going to see that, the cash differential?
Exactly. So if nothing else, just looking at two T12s, one cash basis and one accrual, you're going to see those main differences. But that's just a piece of paper. But there's no doubt when you buy a property, you do want to track in from what was on the rent roll into the general ledger, into the bank statements, what was deposited. Some sellers don't want to give you bank statements, but there's definitely ways around that to still prove out what you need to. Because you're buying a business, right? So you need to make sure the business is performing the way the seller says it's performing. So yeah, without a doubt, Bill, you want to make sure you can verify that deposits are making their way into the bank account.
Right. Well, the time is like zipping by here. It's a shame because I could probably talk to you for 2 or 3 shows here. But one of the things that I thought might be helpful is, since a lot of our audience, they're folks 50 plus in age. Some are approaching retirement, some are in retirement, and they're looking at real estate as a means to be able to not only help fund their retirement years, but to really create a legacy they can hand down to their families. And what kind of advice would you have for those folks? They're starting later, so they don't necessarily have the ramp up time. What would you suggest would be a smart move at this age?
Yeah, I mean, still, I think, becoming, educated obviously is a good thing. It doesn't matter whether you're passive investing, active, or any area of that. You want to make sure you understand. But I also would say is that, anything can look good on paper. In fact, I did a webinar on, tricks syndicators play to make deals look good, right? So making sure you understand that. And then just not looking at, a deal and being like, well, hey, this deal has a higher return, and I'm older, so I need to go with a deal that's higher return, right? That's not necessarily always the best approach, because, a lot of those deals are also riskier. So understanding whether are you looking for cash flow? Are you looking for, preservation? And then mixing it up into different types of deals. I wouldn't personally do just one type of deal, meaning like, just a large value add or just, cash preservation. I'd probably mix that up depending on what your goals are financially. And then trying to split it up between different deals. So if you have, if someone says, hey, I have $500,000 I want to invest and put it in your next deal. Well, if that's all they have to invest, now, it's a big number, right? They have to invest. Don't put all that into one deal. I don't care how good the deal looks. Spread that up, spread it around different deals and, across different types of deals as well. And maybe different syndicators to kind of, diversify your risk.
That's great advice. Thank you. And are you also looking at different asset classes? I know we're only talking about multifamily, but are you yourself in maybe in self-storage or industrial or other areas?
I invest passively in other areas like mobile home parks and some office and things like that too. But as far as active, it's strictly multifamily. But I do think, a lot of those other areas are great potential investments. I just say, no matter what, get educated in a given area before you start putting in, $50 or $75 or $100,000, a big chunk of money, making sure you understand it. You don't have to be, the expert in it, but you need to at least know enough to look at a deal and say, based on what I know, I feel comfortable moving forward. And then understanding, the person you're investing with, as far as their character and things like that as well.
That's great. That's great. Well, Mark, this has been awesome. Good information, and I'm sure our listeners are going to really appreciate it. I don't know if there's anything you wanted to add before we close out. Now, we are going to have you close us out with our old hound dog howl, if you remember that.
I do remember that.
Okay.
Probably all I have to do is stir my dogs up, and they'll get crazy. Have someone knock at the door, and you'll hear a howl for sure. But I'll give it a shot. But no, outside of that, I think it's I really enjoyed the time for sure. And you can't cover everything obviously in a podcast, but people can reach out if they have questions or anything as well.
What's the best way for folks to find you and your organization?
So the website's thinkmultifamily.com, and then my email is Mark, MARK, at thinkmultifamily.com.
Oh, that's awesome. Thanks for sharing that. Wow. Well, are you ready to close us out here? Get your dogs.
Probably not. I'll give it a shot anyways.
All right.
Oh! Sorry, my voice is actually a little bit scratchy.
No, that was great. That was like two dogs in one. That was. How did you do that?
Well, we have two dogs as well, and they actually one sounds like that, and the other one sounds like the other part. So probably mimicking them.
That's going to be tough to match for anybody, I'll tell you. Well, thanks so much for being on, Mark. Really appreciate it.
No, Bill, I really enjoyed it for sure, and hopefully it's not as long next time before we do it again.
Yeah, you've already got me. I've got all these, been writing down little topics here for next time you're back that we might want to spend some more time on. So definitely, I would love that. I also want to thank all our old dog listeners out there, too, for joining us. I know there's a lot of other things that you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate it. Please note everything presented here today, everything that Mark talked about, can be accessed in our detailed show notes on the Old Dogs website at olddogsreinetwork.com/blog, and you're going to look for the episode with Mark Kenney. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.